Hi, and welcome back to the Food Fund, where we explore all things related to investing in food and beverage stocks. If you are new here, our goal is to help you put your money where your mouth is and invest in great companies. If you love food and love stocks, you will definitely love this channel. In this video we will be doing an analysis of Texas Roadhouse and seeing if it would be a great addition to the Food Fund. Be sure to watch through the end of the video where I share my final thoughts on that. Now, let's go ahead and jump right in. Cue the logo. Let's start with some background info on Texas Roadhouse. Texas Roadhouse was founded in 1993 by Kent Taylor in Clarksville, Indiana. Taylor had previously worked in the restaurant industry and he wanted to create a restaurant that offered high quality food and service at a reasonable price. The company has since grown to over 600 locations in the United States and Canada. They serve hand-cut steaks, fall-off-the-bone ribs, and made from scratch sides along with a wide variety of beers and cocktails. Texas Roadhouse has also gotten a lot of attention on the internet, so let's check it out and see what the hype is all about. Starting with the 1-year chart, we see that Texas Roadhouse had a CAGR of about 19%. Zooming out to the 5-year chart, we see that Texas Roadhouse had a CAGR of about 9%. Texas Roadhouse price action has been steadily climbing over time, but it seems like it is due for a pullback to long-term trend lines. Now, let's take a look at the fundamentals. Gross margin is 17%. Not bad for a restaurant company. Revenue has compounded at around 14% over the past 5 years and has reached about $4.3 billion most recently. Good revenue growth and solid gross margins make me hungry for more. Looking at free cash flow, we see a 1% CAGR over the last 5 years, while capex rose at a CAGR of 15%. Free cash flow bottomed in 2020 and rebounded in 2021 as would be expected, but has been declining since then and capex has risen rapidly. Presumably Texas Roadhouse is building out new locations, but it is unclear why they are in the midst of an investment business cycle. Stock-based compensation is flat and accounted for 17% of free cash flow in 2023. Next, let's look at weighted average shares outstanding. Weighted average shares outstanding have been decreasing at about a 2% CAGR, going from 72 million shares in 2018 to 67 million shares most recently. Texas Roadhouse has been doing a great job of consistently buying back shares. Given their declining free cash flow, the share buybacks should prop up per share fundamentals and price growth. Now let's view return on invested capital. Return on invested capital is essentially unchanged over the 5-year period, going from 13% in 2018 down to a nadir of 2.3% in 2020 to 12% most recently. Texas Roadhouse seems to be doing well in the regard, so I do not have any worries here. Another favorite metric is cash conversion cycle, a measure of operational efficiency regarding supplier and payer leverage as well as inventory control. Going from 5 days in 2018 to -3 days most recently, Texas Roadhouse is doing a good job of becoming more efficient. Last, let's explore Texas Roadhouse's debt. The net debt to EBITDA is very good at 1.1 and has been around that level for 2 years. This is a very good sign that the company is managing its debt level well. Debt is of particular interest given the rising interest rates. The fundamentals of Texas Roadhouse are pretty good, though falling free cash flow is somewhat worrisome. In any event, should it be added to the portfolio? Before sharing my final thoughts on that, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. Your continued support means so much to the Food Fund. Now, let's get into my final thoughts. Okay, let's go to the spreadsheet and write out some key values for Texas Roadhouse. It is a restaurant company with a gross margin of 17%. The 5-year revenue per share CAGR is 15% and the 5-year free cash flow per share CAGR is 3%. Despite having falling free cash flow, the share buybacks have kept free cash flow per share growth positive. A return on invested capital of 12% is okay, but I would like to have seen this value grow over the past 5 years. Next, the cash conversion cycle of -3 days is good and still improving. Hopefully these efficiency improvements will soon be reflected in free cash flow growth and enhanced return on invested capital. Concerning debt, a net debt to EBITDA of 1.1 means that Texas Roadhouse could pay off all of their debts with a little over 1 year of earnings. This is a very strong position for a restaurant to be in. So from a fundamental standpoint, Texas Roadhouse is pretty good. Now let's switch our attention over to valuation. Texas Roadhouse is actually fairly valued relative to the S&P 500 with a ratio of 1. The price to earnings growth, or PEG ratio, is 1.3, which means that Texas Roadhouse is a pretty well valued compared to its projected earnings growth. Texas Roadhouse has had great share price appreciation in the last year with good revenue growth and share buybacks. The declining free cash flow growth is troubling as operating cash flow has fallen and capex has increased. However, this could also just be a temporary alteration in the investment cycle. I would like more of a discount given the declining free cash flow, but this is close to being a buy for me. Texas Roadhouse is a strong restaurant company that seems to be pretty fairly valued. For the time being, this is going on the watch list. Many thanks for watching. What do you think about Texas Roadhouse and its declining free cash flow? Please share your thoughts below. It is always great to hear from you. Please check out some more videos right now and don't forget to put your money where your mouth is.